All right, so we're here to discuss Eric Monnet's book, Controlling Credit. We read the first half last time, and this time we're reading the second half called Managing Credit. The first half was kind of an institutional, legal, cultural history around the Central Bank of France in the post-war era. And the second half of the book kind of follows the same period, but is a little bit more focused on kind of the economics and finance of it. And so, yeah, I mean, there's kind of a lot to discuss here. I think maybe, let me see here. I think I don't know if I want to read this whole thing, but the conclusion gives a really nice kind of overview of kind of the main topics that are touched on here. It says I'm just going to read a snippet of it. The goal of this book has been to understand the instruments, goals, and consequences of the Banque de France's policy during the greatest period of economic growth in the country's history. In contrast to widely held views that monetary policy was passive, entirely subject to budget policy, and lacking autonomy due to the fixed exchange rate system, the previous chapters have shown the extent to which the Banque de France's role during this period was robust and economically decisive. By pursuing a policy of credit development, the bank contributed to the expansion and rebuilding of productive capital during the, I can't pronounce French words, so I'm not going to, the glorious 30 years. By intervening in credit allocation in various ways, it supported the transition to growth through investment and reallocation of capital. And he goes on to kind of explain, some of the different instruments and some of the different kinds of, ways in which he's subverting, the kind of prior common knowledge of this era. So, I mean, I thought these chapters were very interesting, especially after, kind of transitioning to more kind of economic research. I mean, we have, regressions and data tables and these kinds of things. But it still maintains like a major focus on the history and historical context. And I think, it gives it kind of a nice blend. Yeah, I think maybe before kind of launching into a chapter by chapter kind of discussion, which I think we can and should, I just wanted to stop here at the beginning and see if people had any kind of initial impressions or comments or kind of high level things that they wanted to mention. Yeah.
So in terms of overarching themes, just the idea of controlling credit and limiting credit via qualitative measures versus quantitative measures, and using things other than the interest rate to control the quantity of credit. I think that's kind of a thread that's there throughout. And you in the quote that you read, you talked about how people thought monetary policy was passive, and he talks about, well, that's because they're looking at interest rates, and that wasn't the main channel through which monetary policy was operating at that time. And in fact, it actually did have a very big impact. It just wasn't through the mechanisms that we think about monetary policy operating through. So I thought that was kind of like an overarching thing. And a question I have related to that is our interest rates really a different kind of thing than these other credit control policies? Or is it just a way of operating on quantities through the price mechanism, which may or may not work very well depending on how elastic the demand for credit is, that kind of thing?
Yeah, I mean, I think that's an interesting question. In the book, one of the kind of arguments he makes, which I think is interesting and maybe challenges this a little bit, is he kind of argues that by separating the price and quantity dimensions of central bank policy, they are in a sense kind of splitting their one tool into two, and thus have two tools to attack kind of to targets. I mean, there's the classic, I don't know, was it the Timbergen rule, which is, that you need as many instruments or like policy levers as you have targets. And so he kind of argues that by separating these two, they were able to use the kind of interest rate in order to manage the kind of current account and exchange rate, while they were able to use the quantity controls in order to manage the kind of like domestic inflation situation. I think I had a good quote for that here, but I'm not sure if I can find it. So I think in some sense, the argument being made is that they are, potentially, different and separate. Now, we don't necessarily have to buy that argument. I mean, we can think about, to what extent that, we agree or disagree. I think another way of thinking about it is that, there are, different prices of credit in the economy, and a certain amount of, he talks about this actually a little bit more, I think, in the first half of the book. When markets are kind of segmented, you can potentially have different prices of credit in different places. So for example, there's, in a sense, when you make a quantity limitation on the amount of credit, there's like a shadow price, a kind of an implicit changing of the price, even if it isn't kind of seen in the market. And you see this all the time with exchange rates, where there's like an official exchange rate and then like a real exchange rate on the black market. And so, yeah, I don't know. Those are kind of my initial thoughts on this. Is I think he would argue that they're two very different tools. And, I think that there's kind of a question to what extent that's possible, because markets are kind of more segmented at the time, and whether that's something that's as feasible these days.
A big theme that came out for me was just this evolution of institutional legitimacy and what legitimacy looked like. So I think it goes to the question of like, are these different mechanisms? Are they the same? But to what extent are they understood as like a mechanism that is legitimate for an institution to use? So I think that was what was interesting, that this I feel like it is untenable today, not just because of the lack of segmentation, but also because what we perceive and understand as, we as in like broader society perceive as legitimate, a legitimate mechanism.
Yeah, just to piggyback on that, I think another theme that we kind of see throughout the book, and he doesn't maybe lean into it as much, but he mentioned several times, and I think it comes up in the discussion of the switch from credit controls to OMOs, and again in the kind of conclusion. But one of the kind of arguments and perspectives on this move from credit controls and discount, like the discounting system, to managing money market rates and open market operations, is that they argue that the latter is more neutral, right? And there's a sense in which that is kind of intuitively true. I mean, the whole kind of point of credit policy, as he talks about in the book, is to allocate, credit to priority, industries and segments of the economy, to, limit excesses in particular areas without kind of burdening the whole economy, et cetera, et cetera. And so, of course, there's a sense in which credit policy is kind of more or less neutral than some of these things. But there's another kind of deeper sense, and I think this comes up again, maybe a bit more in the first half, in which, the markets that are created, that central bank operations, in a way foster markets, and monetary conditions foster particular markets. And those are not necessarily natural markets at all. They're ones that are developed through policy, and the sense in which operating through them alone is kind of neutral, or often the kind of jump from neutral to natural is quite easy. That is less clear, and there are ways in which operating that way favors particular parts of the economy or encourages particular types of finance, et cetera, et cetera.
Yeah, but I think with like the Desan reading, I feel like the reasons to be skeptic of the word neutral and like the word natural, it's just
Totally.
a specific political organization that is using that as a descriptor. But it is interesting because he is describing that moment where that specific characterization gained political force and how it gained political force.
Yeah, and sorry, just a real quick thing, in the kind of institutional part of the book, and in the first half, for example, he talks about how the credit, the kind of like a lot of the central bank and the like credit committee were, at one point kind of had representative stakeholders on the board of different segments of the economy, like labor and industry and et cetera, and later they're replaced by kind of quote unquote neutral technocrats, right? So, yeah, there's like that part of it is interesting too, from a kind of like a cultural study of the kind of economic policy perspective.
Yeah. And another thing that's related to the idea of neutrality, but isn't exactly the same thing, is the question of how simple the monetary policy is, and whether it can be translated between different central banks that maybe want to cooperate with each other or not. He talks about in the book, the European Monetary Union coming together, and if they're all kind of doing their own, bespoke credit control things, then it would be a lot harder for them to get on the same page than if they're, targeting money market rates in a pretty standardized way.
Yeah, I mean, alternatively, it's kind of interesting to look back on the kind of the early history of the Euro system that we've kind of witnessed, in which there's this kind of at least in theory distinction between kind of monetary policy and like banking and credit policy, and that didn't work so well. I mean, because the kind of monetary and banking system are kind of not really something that you can separate from one another. They're kind of the same thing in a sense. The Euro system found very quickly that monetary policy was kind of having this huge influence on banks and the banking systems, and that banking systems kind of moving in divergent ways could create all kinds of like monetary stress throughout the system. So yeah, I mean, I think there's a little bit of maybe hindsight is kind of 20/20 here, but it feels like that was a turn that was maybe ill-advised.
Yeah, I want to quickly bring up this whole approach that he also emphasizes again in these chapters that we just read about the intention across all the different central banks. The objectives were very similar, but the reason we cannot accept one tool or one measure to follow and have a comparative study about it is because there were these measures that were in concert with each other had to be adopted and evolved over time to sort of make the objective work, and they had to work with each other. So that's very unlike so the Anglo-Saxon perspective or the Keynesian perspective or whatever was dominating to work through open market operations or the interest rate. That was not the goal here, or not the tool set here. And so, I mean, that's just a long story short to be able to say he's emphasizing a different institutional setting and how banks are organized, how they work, and how all these different countries operated. So it's very important for us to not only look at one measure or one measure in isolation, but to read in his style, as he called narrative economics or narrative approach, to understand the intention and see how they have applied tools and redeployed tools and evolved tools over and over to sort of get the intended effect. And that's for me, it's very interesting to sort of see. Yes, it's quite clear hearing that argument that we have to sort of have this deep dive of the French system to understand exactly how this works. We cannot sort of be, over the top and just abstract from everything and just look at interest rates. And that's the end of history. And that also gives us a bit of an insight about the nature and the structure of the economy and what needed to happen. Because I think another thing that really stood out to me is that the central bank had to be always countering very high-level problems of the time. And we saw this also, I think, in Perry's course, for instance, for the Fed. It was set up for a very different thing in the early 20th century, but then the First World War happened, and it had to be a dealer in the treasury market. And now that's still what's happening, but that was not at all the charter and the initial intention, but it was facing a specific high-level problem, and it had to sort of, it was a tool that it could deploy there, and it sort of evolved there. And so I think this is sort of a lesson here too. The thing that stands out to me here is that reconstruction, medium and long-term credit was something that was required, and the central bank had to somehow deal with that specific problem and then create discount and rediscount mechanisms to allow for that mechanism to unfold. And like Wim said, we had to create certain types of markets to solve certain kinds of issues that were pervasive in that time period. And I think it's something that we're not used to today, as also Larissa said, is because we're sort of dealing with a globalized economy by default, markets that are easily shiftable or transferable or movable between different markets and different ways of accounting and different monies and different assets. We are so used to this type of system that when things are segmented, we're not used to those types of sets of tools and that approach. Though once we have, so what I'm worried about, and what we've also been thinking about in the last couple of times, is if we think about circuits or different markets, is that we have actually taken away our ability to do more directed things in the economy. And so we have to sort of we're much more in the business of inducing other people's behavior rather than actually directly doing what we think is the right behavior from a state perspective or from a central banking perspective, because of this the lack of the boundaries that we have established currently between different markets, and both within the country but also internationally. And so it gives us very limited tool sets to address specific problems. And that's the conversation we had last time about how do you address inflation. Obviously, the interest rate hikes will not do much right now to address any of the things that we're looking at right now, because we're now in a new world where these things are segmented problems, and we don't have the tool sets to think about this specific issue. But yeah, very interesting. I just want to put that as a high level thing in here as well. And I think the only thing I would like to add is sort of the neutrality argument. I think I'm with Larissa again also, is there was some sort of incumbent rent argument that people were really against, so this internal corruption or this cozying up. We hear these arguments in different versions today as well, and I think the sort of the self-perception of the central bank of being neutral, or economists to be neutral, or civil servants to be neutral, it must have changed over time, because this differentiation of being a bystander and being neutral, and not being a partner, or like partnership could be also positive, but it could also be corruption on the other hand, depending on what you're trying to look at, and you can always make both arguments, I think. But I think that's just an important point to keep in mind. I think there was a shift somehow in how we treat the public involvement in the market, and also what we have to sort of see is that something is really growing here. We're dealing with, it's almost a non-existent private sector post-World War II, and this thing is also massively growing in size and complexity. So we're also dealing with a slight shift of what the public and specifically the central bank is doing over time. And this is not happening only in France, but internationally with the globalization of markets. We have to sort of reevaluate the role of these institutions in that context as well. And I think, yeah, different ideas will have to prevail and be brought forward. But I'm not sure that the thing that we also would like to look at is, I think he makes a small argument about that the inflation conversation, which we were having again today, was not really resolved by simply saying, okay, these guys were wrong, and sort of this new interest rate policy is right. Obviously, that didn't help that much, or was very crude. We don't know yet, or I don't know for certain whether or not those old policies could have been a better policy to address the inflation question of the 70s, rather than what we actually had already departure from those policies. So anyway, those are my high-level thoughts at this point before we get started.
And related to that, just to tack on, we can ask the question, if all we care about is inflation, and we have all these different levers, does it really matter which ones we pull to get inflation under control? Or is that more a question of, well, we're controlling inflation, what other kinds of things do we want to have happen in the economy?
Yeah, on that note, one of the things that I've been thinking about, also reflecting on Wynn's earlier point, you want as many tools as you have objectives, is that when it's a single measure and a single tool, you actually decrease the negotiating, the size of, or like the scope of your negotiating table, or what is it that you can reach compromise on. And this is, again, on Jay's point, that any sort of partnership can be value additive or corrupt, depending on like how is it that you look at it. But I was thinking back to the Kindleberger reading, and how like these very tightly defined ways and understanding of how the gold standard work in some ways like helped decrease how people understood the scope of action that was available to them. And I think similarly, when your monetary policy objectives are too narrowly set, or your scope of action or what you can do is too narrowly set, that also, reduces the potential for leadership. When the fact that if the world is constantly evolving, what you might need to do is something that is somewhat unprecedented. And I think on a related note, the other, on this note of scope of action, a counterpoint to that is like your accountability to the public, and to what extent is more or less transparency desirable, and in transparency in what moment. So I think the example that I think he brings up that is interesting to reflect on that question is on like chapter 5, when we're talking about the Treasury circuit and all of this available mechanisms that these available funding mechanisms to the Treasury were done away with in name of greater transparency, but that also helped like reduce the scope of action, and it was part of like a one additional knock against like the broader framework of like credit policy.
Yeah. I think maybe this is a good point to kind of transition, because now we're kind of getting into some of the weeds a little bit in some of the chapters. Maybe we kind of transition into chatting kind of briefly about each chapter.
I have one more general.
Yeah, please go ahead.
Which relates to a point you brought up earlier, Wynn, about kind of separating the internal monetary policy of the country from the exchange rate policy. And do these types of credit controls, allow you to sidestep the kind of Mundell trilemma of monetary policy? And I wasn't convinced that it would. I wasn't convinced by what he was saying in the book, because you still, at the end of the day, have to have the capital controls in place to allow the credit controls to work. And he was describing that as if that was kind of a different mechanism, but I felt like it was maybe could it be the same thing, just coming through a different channel, the same effect of, okay, your whatever credit control policy you want to use, whether it's interest rates or something else, you have to, if you want to go in a different direction from everyone else in the global economy, you have to put capital controls in place in order to make that credit control policy effective, and that includes interest rates.
Yeah, I mean, I guess one of the kind of things to think about here is that in some ways, capital controls are generally, we think of them as like a quantity control on foreign borrowing and lending, right? And so, I think the way that people often kind of think about it is like, if you want to move the price of money, interest rates in the economy, then you need to and you want to have kind of a fixed exchange rate and all this kind of thing, then you need to limit the quantities that come in and out. And so, I mean, to some extent here, he's kind of suggesting a flipping of that, where you're using the price of money to manage the exchange rate, and the quantity controls to manage the kind of internal creation or evolution of money. But there's an extent to which that is a very kind of high level simplification, and many of these tools kind of use both. I mean, even the quantity controls that he's talking about often have a price component of them, which when we get into some of the details here a bit, but the credit ceilings would often allow people or banks to borrow above their credit limit, but at a penalty rate, or similarly, capital controls often are not just purely a quantity limit on the amount of foreign financial transactions you can do. I mean, sometimes they are, but often they are a tax or some type of extra surcharge that are used to discourage it. So throughout, I think it's helpful to kind of flatten some of these distinctions for thinking about them a bit analytically. But once we get into the real thing, there's often kind of both price and quantity tools kind of at work, even in the same kind of operation. So I don't know.
Just a quick thought on this. What I was thinking here is, okay, because obviously when we're thinking about credit policy, we're talking much more specifically about not general markets or macro quantities. We're dealing actually also with the banks themselves, and there's a limited amount of them. So we're talking about specifically limiting inventories of the banks. So the way that I thought about this trilemma issue that you just mentioned, Alex, whether or not credit sort of capital controls bind or not bind in a certain instance, it's almost like a different category. So you're telling banks you cannot do certain things. So the foreigners who are trying to come in, or the domestic people who are trying to go abroad, they have to go through the dealer system, which is a very limited subset of people and institutions that have to now follow whatever they can do whatever they want, but they have all these quantities to work with, or these ceilings or these floors to work with. So it is basically managing much more directly inventories of different banks, which is I'm not sure. Perry at some point in his course also talks about this, but there is a black market or something that why about how accounting happens in different branches and different, once the banking system becomes more complex and elaborate and international, then we have a problem with any type of control, credit or capital controls, doesn't matter, because then all of a sudden you have these accounting tricks or these offsets that you can do. But absent that, you do have to go through the specific dealer system, and what these credit controls do is sort of specifically manage the inventory. So that tells you something about why or why not a macro measure like the capital control is binding or not binding, or why it's not that interesting as a measure for the French banking system, because they're actually looking at what's happening here domestically in terms of the inventory and the balance sheets. but I didn't think it through completely because I didn't know exactly what the connection is. Like, what exactly, how do we actually manage this connection between capital control, which is sort of wholesale for the whole economy, and how we make this sort of targeted credit inventory management of the big banks that are dealers in these markets? Not sure.
Yeah, I think there's a sense in which people who interface with those banks who aren't directly regulated, but who interface with the banks who are regulated, might just go around those institutions and go to the international capital markets for lending and borrowing. And that's what they're trying to prevent. They want to have them go through these regulated banks.
Yeah, I'm not really sure what the process was back in the 40s and 50s and 60s, but I think at some point we do have this sort of flip where there are markets, no longer, individual banks using their balance sheet as the market, if you will. So I think it's really interesting for us to understand where that shift towards actual currency markets happens, or where those exchanges happen, because that limits the extent of these policies being successful or not.
Yeah, that's a good point, because at the beginning of all this, you might not have something that looks like what our international capital market looks like today.
Yeah, and I mean, I think later in the book, and then maybe we should save it a little bit for when we get there, but he kind of talks about the breakdown of the system and like the growth of kind of international capital flows after Bretton Woods is kind of a big part of it. Let's launch kind of into the chapters. We don't have to spend a lot of time talking about each one individually, and we can kind of bounce around a bit. But I just kind of want to make sure that we all get to kind of briefly have kind of a high level perspective and a chance to kind of dig into some of the more kind of meaty parts of it. So my plan was just to, if you don't mind, I'd give like maybe a 3-minute summary of the chapter, and then we could kind of chat about and any other kind of questions you'll have from it. Chapter 4, which we might want to spend a little bit more time on, is I think very interesting. It's called Monetary Policy Without Interest Rates. And the kind of high level summary is, I'm going to kind of look at my notes here, so apologize if I'm kind of staring off screen. So quantitative controls changed over time, and so there isn't kind of a unique measure for any of them. It's not like just the interest rate where you can measure the stance of monetary policy by just looking at the interest rate go up or down. And so he's going to use the kind of narrative approach that Jay alluded to earlier. And this is something that's been used in the monetary policy kind of economic research literature, where people, instead of using interest rates or other indicators of monetary policy, they kind of do very careful historical documentation of when the central bank says it's kind of tightening controls or not. And they, construct a variable that kind of is coded 1 when this is, tight, and 0 when it's not. And then you can use this in your kind of quantitative analysis. And so he's going to use this once he starts doing more kind of econometric results later. What else? He mentions that capital controls are important for making the kind of credit controls binding, which is something we talked about. And so there's 3 broad categories of tools that of kind of credit control tools that get used. One is like what he would call like credit ceilings. And in credit ceilings, basically, if the banks are allowed to, have a certain amount of growth or a certain level of lending each year. I think, I wish I had it here actually, but I think he shows at some point some of the different kind of credit ceilings, and they're often kind of high. It'd be like 11 or 14% credit growth in a year or something like that. The next tool is the rediscount ceilings, where a bank makes a loan and then they can rediscount it to the central bank, and the central bank will essentially kind of let them finance against that loan at some rate. And here, the bank, the central bank would often have kind of bank-specific credit ceilings or rediscount ceilings, but then could raise or lower all the ceilings at once to kind of have a broader macroeconomic policy. And it could also choose to allow certain loans to be rediscounted and others not, and this would be a way to affect, a certain amount of allocation or encourage lending from one to another. And then the third kind of broad categories of credit tools were liquidity and reserve ratios. And so, the reserve ratio, we kind of, I think, know decently well, which would be, proportion of reserves need to be kept at the central bank in proportion to deposits. He mentions that, sometimes these ratios were also based on the amount of loans, not just deposits. And that the liquidity ratios were typically of the form of, requiring the banks to hold a certain amount of like treasury bills, for example. And this was kind of important in two ways. One, it allowed the central bank to control the amount of and the cost of kind of liquidity at the banks, but it was also a way of kind of making other credit controls effective, because if you limited the amount of credit that a bank could extend, then it could potentially sell off its treasury bills and then extend more credit to businesses by kind of liquidating its treasury bill portfolio. So this made credit policy more effective. It of course helped accommodate government finance, and it also kind of had the traditional effects of affecting the liquidity that banks had. And then finally, the last thing I'll mention in this chapter is that he does some econometric analysis using the kind of narrative approach that I mentioned before. And in that, he finds that tighter credit controls resulted in, money aggregates going down, the price level going down, industrial production going down, unemployment going up. The money market rates were not affected, and that bond rates, like government bond rates, went up at first and then down later. In contrast, when he tries to do a similar analysis using, the interest rate or using the foreign interest rate, the U.S. interest rate, which the Banque de France's interest rate was tied to, he doesn't find any of these results, and that's because, of course, as his story suggests, the interest rate was not the main kind of macro tool. The last thing I'd mention on this is that then he asked kind of what kind of predicted the use of these credit tools, and of course it's when inflation was high, or the credit or the current account was going into substantial deficit. These were kind of predictors for the central bank. Choosing to tighten its credit controls. So that's kind of like the my overview of chapter 4, which I think is kind of the most extensive of these. But I don't know, do people have any kind of thoughts, or did this chapter kind of, did you have any questions from it that you wanted to mention?
Okay, I got my slides. I can just show them to you because it took a long while. So.
Oh yeah, please. I think I just made it so that you can share. See if you can give it a go. My signal's pretty bad, so I don't know. Hopefully I can see them. I can. Oh, amazing.
Yes.
Well done.
So this was just because I was trying to follow what was happening when, and I can only do that if it's, visually presented. So I can send this over. This is the timing across the 3 different categories that Wynn was talking about. This is how they
cool. You should
changed.
totally send this to Monnet.
Yeah, and then in the background are like the 6 episodes. And what I was trying to do, and then I ended up not having time, was just a little bit more detail on each of the 6 episodes and what was it that created them. So that's why I did not reach, didn't finish chapter 6 and 7.
You were spending your time investing in that very impressive chart. Yeah, no, please share them with the group. I think that's super cool. It's very nice to visualize it. Yeah, did other people have kind of thoughts from chapter 4? I can.
Yeah. Or go ahead, Larsa. Yeah, so this narrative approach in kind of figuring out whether the central bank is being expansionary or contractionary, it kind of prompts the question, why does it matter? Why is it useful to kind of go back through history and classify whether a central bank is being expansionary or contractionary at any given moment? And maybe sometimes there are obvious, measures they're taking to fight inflation or something like that. But maybe it's something less obvious, and then you have to kind of ask the question, well, expansionary relative to what, contractionary relative to what? And this relates to the question of if you have a lot of levers available to you and you happened to use some of them in the past, and you know which way you want monetary policy to go, it's too expansionary right now, right? Maybe it's not expansionary overall, but it's more expansionary than you want it to be, or however you want to frame it. You know how to pull the levers in the direction you want. So what does this history get us? What does, in what sense does it inform us on monetary policy and what's useful to do with monetary policy?
I mean, I think one answer, which maybe is not super satisfactory to people kind of outside of a more kind of academic research perspective, is that he can do statistical work on these questions, which would be very hard to do otherwise. I mean, traditionally, what someone would do in kind of a more modern setting is if you wanted to ask, does monetary policy work? And if so, how effective and what are its unintended consequences? You might look at something like changes in the interest rate and then see, how those are, statistically related to unemployment, inflation, and the current account, and these things in the future. But as he says, for credit controls, that's very hard because there's many different kinds of tools, and you don't have kind of one measure like an interest rate that you can easily kind of put into your kind of statistical analyses. So I think the advantage is that the analysis that he does at the end would not be possible otherwise. And so someone could naturally ask, did credit policy matter? And in some sense, he's kind of arguing that many people have a perception, and the research kind of to date has treated monetary policy at the time as very passive and ineffective and not doing much. And he, because he uses this narrative approach to construct a variable that he can use for this kind of econometric work, he can offer some rather compelling evidence that these credit policies were in fact quite effective from a macroeconomic perspective, that they had some effects that we think are intuitive with kind of economic intuition or economic theory. And I think that the answer is it kind of lets him do quantitative research.
Yeah, I think that makes sense. If you have people out there who are saying that monetary policy doesn't work, here's the historical evidence for why it doesn't work, then he can come back and say, hey, no, you're looking at the wrong thing.
Yeah, that's kind of the way that I interpreted it. One other thing that I forgot to kind of mention in here, and this is more kind of just a historical tidbit that I thought was interesting, but he talked about how before World War II, the Banque de France would not allow any loans to be rediscounted that had a maturity greater than 3 months. And in this chapter, he mentions that after World War II, they allow rediscounting of long-term credit up to 5 years. So I think, and we'll talk about this a little bit more kind of in the later chapters, but, in other readings that we've done, we've kind of talked about how, early central banks had this kind of focus on rediscounting short-term, real bills and, bills of exchange and this kind of thing. And, so this is a moment when we see this kind of transition from a quote unquote, cult of liquidity to these kind of long-term lending, and in the later chapters he shows that the kind of increase in long-term lending was kind of an important part of capital accumulation and infrastructure building. I think this is one of the areas where it potentially has kind of interest in relation to things that people are talking about today, whether it's kind of financing long-term investments in the green transition or these kinds of things. I think that that's where some of this potentially has some traction in the debates of more contemporary policy.
Yeah, and I think also this was really a good explanation, Wynn. I think also this issue speaks to the fact. I mean, the inflation question was also pretty clear because, for instance, the real bills doctrine, just to recap that, said, okay, we can only rediscount bills that will churn into money, into a payment very soon. So that's the reason it's not inflationary to accept those types of real bills, as many as we like, and not have to worry too much about it, because even if we're holding it, the liability structure of the central bank will, you're not expanding balance sheets limitlessly. But in this case, you do have if you're now funding the capital market, essentially you're going away from the money market into the capital market. You're no longer expecting a cash flow your way once you're discounting those bills. So it's exactly the kind of question that Schacht, my thesis, was also sort of worried about, that the fact that these bills have to be held, and there's an institutional question. You cannot accept that these bills are actually en masse being rediscounted. So there's a management and a relationship that you have to have, and you have to have an accord with the holders of these bills that they are not going to just dump it on the central bank and create an instant inflation. So there's a very big nuance and a much more relational sort of approach here that you have to have in order to be able to conduct this type of policy, but also where the direction is clear. You're trying to sort of show more long term where things are going. And this is a very different world, because you're bootstrapping a market. You're basically saying, hey, yes, you can go out there and lend that. You're not going to limit the possibility of your bank by going out and lending these long-term things. You're going to you have the option of offloading some of those things to our central bank if you really need them. And that's a very different problem than the London banks had to face when they were rediscounting trade. And there was no lack of capital. That's the other thing, right? There was no lack of capital in Britain where that problem had to be solved. So here we have a lack of capital, and you have to somehow have a direct policy of capital accumulation. And I think this is a super interesting problem for us to solve, going to Alex's question, because I'm now worried about and interested about what do developing countries do in terms of their monetary policy, because it's not simply adopting. We know that doesn't work, just going and saying, hey, we are just going to do what the Fed or the Bank of England are doing, because one, you're not dealing with the same market structure. You don't have this financial depth to actually manage a market. So you're not you can't sort of be passive and allow the market to sort of work itself out. But you also don't have that much capital to work with. So you actively have to somehow contribute to the capital accumulation and the direction of policy for the country, partly because you're an active participant in the market in the sense, and somebody who's directing the market and building the market for a developing country. So we were asking the question you asked, what is the purpose? I think we're also rehashing a conversation about development. I think that's really important here, because it's reconstruction. It's different. It's a very different conversation of development versus reconstruction. We have to be very clear about that. It's a very different circumstance, but I think this analogy here is very similar to the 1930s, the thing that I studied, which was also how do you actually, first of all, mobilize and bring things that are already there into capacity, utilizing full capacity in the absence of capital. That's one question. But then for developing country, you don't have that capacity, and that's another hurdle that you have to go in building that, and that's a tricky thing because you have other types of risks that you don't have in this reconstruction that we're currently looking at.
Yeah, another thing that really struck me in this chapter was how much it was a bit trial and error, and how much innovation there was happening in the tools that they were using. So across those three categories, all of the subdimensions were evolution, as whatever they had done before was no longer working. So it's just interesting to have that institutional space for experimentation. And then there's a question of when markets are more integrated, in what ways does that impact the institutional space for experimentation?
Well, question to Larissa or everybody, maybe that experimentation is actually happening, but we're just not looking. If we're all just focused on, hey, what is the Fed announcing? But there's how many departments in the Fed actually doing stuff that we're not aware of. There's other kinds of policies that are being introduced. I think there's a lot of experiments that have always been undergoing that we just don't hear about because we're just not looking. I'm wondering how much.
Yeah, and I think the COVID crisis, every crisis shows a ton of experimentation, and it creates the legitimacy, to move across, defined boundaries of what worked before. But it's a question of to what extent does integration constrain what's possible? So I'm thinking for emerging markets, for developing markets, can they experiment? Are they able to experiment more versus less? And I'm just thinking of, the Mundell trilemma. If there was more segmentation, would they actually be able to be doing more?
Yeah, it's an interesting question. I'm curious to what extent policymakers look at central banks of developing countries for ideas, because they're more in the kind of position that the Banque de France was in this time period. Yeah, I don't know.
Yeah, I mean, it's funny that you mentioned. I remember that after the global financial crisis, there was this big interest in using macroprudential tools, right? And this, suddenly became kind of a hot topic. And, a lot of people at the time kind of rightly pointed out that a lot of these kinds of tools were being used in emerging markets all over the place. And, started trying to kind of ask to what extent those were, provided useful kind of case studies and this kind of thing. And I think as, Monnet says in the conclusion here that in a sense, many of these kind of macroprudential tools often are, either the same or very similar to a lot of the kind of credit control policies that were being used previously. And so there's a sense in which, some of these kind of policy tools, never really went away. They, were just kind of being, used primarily in emerging markets for an extended period, and now have started to kind of return to, the kind of quote unquote advanced economies. And I think that there has been some kind of like lessons learned from emerging markets kind of research and discussion. I suspect though that there's a lot of kind of questions about, how well some of those questions kind of experiences kind of translate or inform other economies, just because a lot of them are often in very different situations, right? They're often very small and will have, large external accounts and, capital, challenges with exchange rates and capital flows. And so, these kinds of things, may make the kind of effects of these different policies kind of very different there than they would be, say the ECB or Japan or the US did them or something. Should we maybe, I mean, we can obviously come back to any of these topics, but I just kind of want to make sure that we at least get a chance to briefly chat about each chapter. Chapter 5 was short, interesting. In some ways, it feels a little bit of a, I don't know if it's really a tangent, but it's a kind of a more fiscal monetary policy interaction kind of chapter. And so it's about kind of the role of the Central Bank of France in financing treasury and fiscal policy in the period. And it mentions that during World War II, there are lots of loans to the government from the central bank, and often loans to the central bank or loans from the central bank were collateralized with government securities that they could go sell on the market. Typically, the loans were in the form of kind of credit lines with a zero interest rate, and so in a way, this just kind of gave fiscal policy kind of direct access to monetary financing. But then after World War II, kind of explicit government advances were made illegal, and the way that a lot of the lending occurred was either was through what he calls kind of hidden government finance, which is to say that it kind of operated through these kind of public or semi-public financial institutions that had a relationship with the fiscal authority and also with the Banque de France. And he mentions that some of this was done in part because they would not appear in the kind of accounting of the central bank, and therefore disclose the extent to which the fiscal authority was relying on kind of monetary financing. I won't go into all the details here, but he mentions a couple of ways that this happened. One was through discounting government bonds, or guaranteed bonds. So a firm that couldn't pay its taxes would promise to pay its taxes later, and then the Treasury could take these to the Banque de France and discount them to get a loan. And this would appear in the statistics of the Banque de France as a normal commercial discount because it was a credit from the like firm that couldn't pay taxes. Then there's discounting CDC construction loans, where the CDC was this public credit institution for social housing and long-term investments. The CDC could deposit funds from its rediscounting with the Banque de France in the Treasury's account, and the Treasury could ask the CDC to rediscount more loans whenever it wanted to get access to more funds. They said this basically accounted for at sometimes as much as a half of the funds to government, or the Banque de France's funds to government. And that this system kind of went away in 1973 when they kind of tried to make the records of the central bank more transparent. So yeah, I thought that this was kind of an interesting chapter. It's maybe a little bit less about, well, I don't know. When I think about credit policy, I'm always kind of thinking about the way in which banks are kind of allocating credit to the private sector, but this is more kind of about allocation of credit to the government, and then the kind of the relationship between monetary and public finance. I don't know. What do y'all think about the chapter? Do you think do you have any questions or parts of it that you thought were interesting or curious?
Yeah, I had one thing that stood out to me, which is that he talks about the central bank's direct loans to the Treasury being replaced by kind of this market-based borrowing, and how that gets around the central bank having to tighten monetary policy as a condition for giving a loan to the Treasury. And it occurs to me that one of the ways we tighten monetary policy is by selling treasuries onto the market. So in some sense, at least maybe to some extent, by borrowing directly from the market, the Treasury is doing its own monetary tightening simultaneously to the spending that it's spending into the economy. Whereas if they borrowed from the central bank would then have to sell the whatever, something equivalent to treasuries onto the market in order to tighten or do some other kind of credit control or something like that.
Yeah, I thought this is interesting, and yeah, I think, you know, this is something that's come up several times, and, you know, I don't know if this is really, you know, resolve it here or something, but that was kind of my last bullet point that I didn't get to because I thought I was getting a little long-winded. I think it's an interesting question. I mean, the way that I often kind of hear people talk about this, and I would need to think about whether I really believe this, but like the way that I often hear people, or sometimes hear people talk about it is, you know, like if the government wants to do some spending, you know, it in a sense is going to kind of create money to do that, or create, you know, it creates kind of spending power to do that. And when it does, you know, someone is going to get income, and so the kind of amount of money in the economy goes up. By issuing a bond in some sense to finance that, or quote unquote finance it, the government is kind of like sucking dollars back in, right? So like if you think that, you know, if you think that kind of by locking up you know, dollars or kind of short-term monetary liabilities in these kind of longer-term instruments reduces inflation, then, you know, yeah, then that's the kind of way in which I think that people kind of argue that this kind of thing is, you know, less inflationary. You know, I don't know. I have to think a little bit. You know, I always get a little bit reluctant with some of these kinds of very kind of quantity of money-esque kind of perspectives on things, but you know, yeah, there's a sense in which it makes a certain amount of kind of intuitive sense to me. And so, yeah, I thought this was kind of an interesting question. I mean, you know, he kind of argues that this move to marketable public debt rather than, you know, monetary, like central bank monetary financing was, you know, less inflationary. That's interesting. You know, that's what people argue. Of course, inflation went up in the 70s and was relatively contained before. So, you know, of course, there are many other things going on.
Yeah, there's what you said about kind of the issuing the treasuries, sucking the reserves back out of the system. There's that, but there's also, you know, if you flood the market with treasuries, that's going to drive down the price of treasuries and increase the yield on treasuries. So that increases the floor on interest rates even further out the yield curve, and that's potentially going to have a contractionary effect on credit as well.
Yeah, I mean, you know, I think as we kind of talked about before, there are also, or in like previous sessions, there are also kind of interesting questions about that, you know, the extent to which kind of supply and demand, you know, make a difference or not for kind of financial market prices and stuff. I mean, you know, I think a lot of people with the kind of current quantitative tightening, you know, when there was no kind of quote unquote taper tantrum and things like that, people have kind of asked, oh, like, you know, does it really matter? And, you know, of course, there are kind of questions like during different phases of quantitative easing, interest rates haven't really changed a lot. And, you know, so I think, again, you know, some of these things are things that make a certain amount of kind of sense when you think about them kind of intuitively, but then once we kind of get into some of the mechanics, it gets a little suspect, and then you start being a little unclear. Larissa, you look like you wanted to come in.
No, I guess I was just trying to digest what you were saying, because I think the thing that confuses me in that is that by increasing, because like we have markets to monetize treasury, like what the interaction with that is. Because like you're increasing like monetary capacity like for banks, right?
Wait, could you explain or elaborate?
So the more because like we have like well-developed repo markets and like treasury is high quality collateral, it's something that, you know, like individual actors within banks like feel more comfortable with like deposit creation when it's backed by treasury.
So maybe part of what you're saying is that when the government borrows in order to spend, they spend the new money into the economy, and then they replace some of the old money with treasuries, which is just another form of money. Is that kind of what you're getting at? Or
Yeah,
close to being another form of money?
it's
Yeah.
close to another form of money.
Yeah, I mean, you know, to kind of push the conversation a little bit, and you know, this is a bit tangential, but you know, I mean, I don't know, we're reading the book is interesting, but we're kind of here to have broader discussions too. You know, I mean, there's this whole, and of course there are many. This is an oversimplification, but you know, I mean, there's this kind of idea of like Wallace neutrality, which I guess is kind of like the Modigliani-Miller theorem for government finance, which, you know, in the Modigliani-Miller theorem is this kind of idea that like, in theory, in a very simple theory, it shouldn't matter how, you know, firms finance themselves, you know, whether they borrow short term or long term or whatever. And of course, there are many reasons that, you know, it does matter in reality, and that reality, you know, kind of diverges from the simple assumptions of the kind of Modigliani-Miller theorem. But like the kind of public finance alternative to that is like, doesn't matter how the government, you know, finances itself. Doesn't matter if it is, you know, a bond, if it is a bill, if it is paper currency, if it is a loan, a long-term loan from the central bank, a short-term loan from the central bank, you know, if it is a credit line, you know, yeah, do these things matter? And I mean, in the book, you know, the kind of discussion here is, you know, whether it matters economically or not, it certainly mattered politically and institutionally. And so it was kind of, you know, an important thing. And it was an important thing, you know, the way in which it, you know, gave the central bank a certain amount of leverage over the government in ways that, you know, we may not find super appealing from more kind of democratic perspectives, right? It may matter, you know, in the way in which it makes, you know, certain kind of economic policies more, you know, politically, you know, costly or otherwise. But yeah, on the economics of it, it's, you know, I mean, yeah, it's kind of an open question, I think.
Yeah, I feel like wasn't that Gurley and Shaw?
Yeah, I feel like maybe, I don't know if I got to that. It sounds like something that came up in Gurley and Shaw, but I didn't read the whole thing, so I'll probably know better.
Trying to pull my notes.
Is which part Gurley and Shaw?
That how the government finance itself matters economically.
Yeah. Yeah. And how the different businesses finance themselves too. And you've got this kind of like heterogeneous bonds that are issued and that have different properties and that kind of thing.
Yeah, I mean, I do remember the kind of parts from the money interest and the public interest, in which he talks about the Gurley and Shaw work on financial sector development and the difference between kind of like banks, bank funding and stock market funding, and yeah, I mean that. Yeah, that's kind of an interesting question too. I mean, yeah, in that sense, it matters kind of, yeah, it matters economically, but maybe not in the way that I meant. But yeah, no, you're right. You're right. That was kind of a discussion about essentially like what finance is feasible depending on the preferences of kind of investors and investors and borrowers. Yeah, I guess here the extra dimension to that is like bringing this more kind of explicitly monetary dimension of it. Like if we kind of exclude capital market lending and we just think about, a loan to the government versus kind of issuing paper notes or something, is that, yeah, I don't know.
Yeah, and I think the reason that I was just like grappling as it is because it seems like it depends, but then for me, I don't have the super clear answer on what does it depend on. And I feel like even through Gurley and Shaw, there was, a series of different scenarios of like kind of teasing apart, like, oh, all of these things matter, but matter how much, to what degree, I think is still muddled in my mind.
Yep.
So maybe it's a good time to kind of shift on to the next chapter, just to make sure that we're kind of making our way through here. So chapter 6 was the financing of the golden age, and to give kind of a short summary of it. Let's see. So post World War II was a period of high investment, which is interesting because it's also a period that people kind of have historically referred to as one of financial repression. And so this kind of already poses kind of an interesting question to explore. And I think is part of the way in which he's kind of revisiting some of the broader historical narratives about the period. He mentions that before World War II, banks did not lend long-term, but afterwards they did, which is an interesting coincidence given what we kind of talked about in chapter 4, which is the central bank, encouraged long-term lending by allowing long-term loans to be rediscounted, which it hadn't done prior to World War II. And in the period, there was this, I guess the sort of bank defined long-term loans to firms as investment credit, and created statistics on investment credit to different sectors, which is going to allow him to do some analysis on where long-term lending went, and whether it had any kind of beneficial or negative effects. And he mentions that the way to kind of think about this period is not that the state was some kind of centralized social planner, but instead that it kind of provided guidance and incentives, but banks still kind of chose who to lend to and in what amounts. The Treasury financed long-term lending according to kind of government priorities, and but this kind of had kind of a big burst in the early 50s and then tapered off. Loans from public and semi-public financial institutions prioritize public housing, agriculture, small businesses, exports. And then the Banque de France, kind of contributed to the kind of encouraging investment at the time through rediscounting policy, particularly kind of medium-term notes. And so, they provided bank level rediscounting ceilings, but this would be kind of based on the amount of deposits they had, the economic utility, quote unquote, of the industries to which they were lending. They would allow kind of longer term or rediscounting of longer term loans for priorities like housing and construction. They would provide guidelines and commitments to rediscount specific loan types that were kind of a high priority. And the Banque de France often would not rediscount loans to unprofitable firms and things like this in order to kind of mitigate potential moral hazard. There were often kind of exemptions to other credit controls like credit ceilings. For example, exports were almost always exempted, and sometimes housing. But it's very rare that there's any direct compulsion for lending. And yeah, so then he does some quantitative analysis. He finds that the sectors that received the most kind of investment credit were the ones that accumulated the most capital over the period. And then he also does a little bit of analysis looking at kind of reallocation and whether productivity could have improved or got worse. In this area, I got a little bit confused. I don't know if maybe it was just kind of my reading, or if maybe, you know, there are some typos in some of the explanation. Because at one point it sounds like he's kind of saying that the areas that had more investment credit had kind of higher productivity, but then at another point it makes it sound like that's not the case. And so that part was a little bit fuzzy, and be curious on y'all's reading. That's kind of my summary of chapter 6. Yeah, I know. Open up to thoughts, questions, initial kind of, yeah.
Yeah, certainly the idea that you had this really functional system that today might be characterized as, you know, a regime of financial repression. I thought that was, yeah. In terms of kind of the contradictions you found in there, I'm not sure I have anything to add to that.
Yeah, I mean, I'm not so sure it's kind of contradictions, or it might just me kind of not reading it super well, or being a little bit confused. But I think, for example, at the end of the chapter, I think it is chapter 245, or page 245. Let's see. He says, well, so at the bottom of page 244, he says, a quantitative analysis based on disaggregated sectoral data of the economy over 20 years has shown that this institutional configuration produced an allocation of investment credit that was able to support capital accumulation and productivity gains. So that makes it sound like these kind of policies improve productivity. Then he says the stock of capital grew more on average in sectors in which the growth rate of investment credit was higher. So that makes sense. Capital was accumulated where credit was kind of allocated. Then he says, but the sectors that experienced the highest growth rates of the stock of capital and investment credit were not the most capital intensive ones. The most capital intensive, which that part also kind of makes sense. He's saying that essentially they like reallocated credit from very capital intensive sectors, maybe like manufacturing, to other ones like agriculture or services or small businesses. Then he says, thus, the most capital intensive sectors were also those that experienced the highest gains of apparent productivity and capital. And so this is an area where I'm a little confused, because it makes it sound like capital is being accumulated, or the credit is being, how do I put it? The industries that are the most capital intensive are having credit allocated away from them and towards the other firms. And so then you would expect, if these policies kind of improve productivity, for them to be in the places that the new credit is accumulated.
I think it's more that the more capital intensive sectors are not building new capital. So they have the same fixed amount of capital and they're doing more with that fixed amount of capital. So they're more productive, you know, like just in terms of relative.
That's right. And he says something like that in the next sentence, but I was a bit confused by it. So he says, it would not have been the case if the, again, French word I can't pronounce, so I'm not even going to try. Dirigist system had overflowed these sectors with too much credit without reallocating funds towards the less capital intensive. So, okay, so then if I'm understanding what you're saying, and now that I kind of read it for a third or fourth time now, I think I'm finally getting it. The idea is that the credit allocation system reallocated credit away from capital intensive to non-capital intensive. The productivity gains happened in the capital intensive ones, but that would not, I guess, necessarily have happened had they gotten more credit, because then they would have been using more funds and not being,
they would have built unproductive capital. Yeah. exactly.
Yeah. Okay, that makes more sense. So then overall, the whole system is more productive, even if it's not precisely where the credit was allocated.
Right. Where the credit was allocated, you're producing more, but you're not necessarily increasing the productivity per input. But
Right.
because the credit is going away from where it's not needed, then you're overall more productive.
Okay. Yeah, that makes sense. All right. I got it. Thank you. Yeah, I don't know. I thought it was interesting. I mean, I don't know. We should wait until the next chapter to well, yeah. Actually, maybe I'll wait to the next chapter. But I thought this was kind of an interesting high-level perspective. It was also nice to kind of then take a lot of what we've kind of focused on, like banking and monetary policy and this kind of thing, and tie it back to the real economy a little bit. I think that gives it a little bit more teeth. I mean, in a way, with everything kind of before, you say, that's interesting, and I guess we have seen some kind of macro effects and stuff, but this kind of reallocation story, I think, is kind of a big question, and I think it's something that traditionally you kind of hear people say that these kind of credit policies lead to financial repression and unproductive blah blah blah, and there's going to be zombies everywhere. And I thought that this was a nice corrective to some of that, to think, well, maybe there are ways of kind of approaching policies like this that are a bit more intentional and thoughtful and kind of balanced, that harness some of the kind of incentives and power of the market, where banks are still kind of choosing who gets loans and stuff, but the government is tilting its hand a bit on things that it think are kind of obvious priorities. Yeah, so I don't know. I thought that was an interesting perspective.
Yeah, what I thought it was interesting is this, it breaks free from, a vision of a dichotomy that either you're a centralized planning or decentralized market. So it's like a little bit of both. And it kind of reminded me of an experience that I had like many years ago, that I was looking into different countries' policies in incentivizing financial innovation. And some countries, like notably Israel, had basically a government VC fund where they supported like one tranche. So it was directive in that sense, yet there was still a market component that certain investments would only close if like they reached a certain amount of like buy-in from the rest, from the market. So I feel like there's also, again, in the spirit of like, there's probably a lot of experimentation with this happening within departments across the world, but then it's harder to then tie it back to how it connects to policy with a capital P, the central bank.
Yeah. I think maybe this is kind of a good place to also kind of transition a little bit to chapter 7, because in some ways I think these chapters kind of are very related to one another. In chapter 7 is about the rise and fall of credit policy, and takes this more kind of international perspective. And so, he kind of shows that other European countries had similar policies. He looks, at Germany, Netherlands, Italy, I can't remember, maybe one other place. And that, most of these kind of unwound a bit before the European kind of monetary union, or the kind of like ramping up and gearing towards it, but in some ways was not really the result of that effort, but more a result of the kind of different national challenges that people, different countries were having with kind of credit policies and managing kind of macro financial policy nationally. He takes this perspective of kind of the quote unquote varieties of capitalism, where he says, we can maybe look at different categories or types of capitalism in different places, like a market capitalism in the UK, managed capitalism in Germany, and state capitalism in France. And that during the kind of credit policy period, bank regulation and was not really kind of separate from monetary policy, in part because of what we were just talking about. There were kind of like bank level credit restrictions and things like this that feel a lot like kind of more traditional bank regulations. One thing that kind of all of the examples had is pretty much all of them had favorable discounting for export loans. And then these pretty much all of them began replacing credit controls with open market operations and a focus on managing money markets. And this was part of a broader liberalization and attempts to fight inflation in the 70s. Rather, in these kind of domestic concerns rather than the EMU. One thing he doesn't mention here, and this is one of the reasons that I kind of wanted to join this conversation with the last chapter, is he didn't really talk about the US. I mean, he talks about it kind of briefly in some of the previous chapters, but a lot of the things that he's kind of talking about central banks kind of, helping out with or encouraging or incentivizing are things that actually in the US, occurred too, just not through the central bank. So, encouraging housing credit, no one does more of that than the US. I mean, the US has the, Fannie and Freddie and the GSEs. They're kind of going through the Treasury Department, either implicit or explicit guarantees. And so it's kind of a different way of allocating credit through the kind of fiscal authority rather than the central bank. And of course, the U.S. does a bunch of other stuff. Like it has the federal farm, home farm banks, farm home bank, whatever the federal. Well, yeah, I can't remember. There's like the farm banks. There are a bunch, and so there kind of a lot of these different ways in which the U.S. is kind of doing kind of similar type of ultimate policies, but not going through the central bank. And just because the conclusion is short, I'll just briefly mention the kind of main points that came out of that. It mentions the rise of international capital flows in the post-Bretton Woods area was kind of one of the major challenges to credit policies. Capital controls played an important part of complementing them. Many of the kind of macro-approved tools that we have now and the reliance on policy tools like funding for lending programs and LTROs and TLTROs are very similar also. And then as these things grow, we might see the independence of central banks kind of recede a bit in a way that they kind of did during this period too. And so that kind of maybe relates some of these things to the present. So yeah, I don't know. Did people have any kind of thoughts on kind of last chapter conclusion or the way they kind of tie the previous chapter?
Yeah, I think this is going to segue well into the discussion of the menace of fiscal QE. I think it's an interesting question. What is the appropriate role of the central bank? Do you want them to be just ensuring that the banking system and the financial system is stable and stabilizing the price level and maybe even doing something with unemployment or something like that? Or do you want them to do more targeted stuff? And like you said, if you want more targeted stuff, it doesn't have to be through the central bank. So why would we want to do it through the central bank? Why wouldn't we? That kind of thing. I don't know.
Yeah, I think the part that's exactly where my mind was at was like what should be the boundaries between like a central bank and an industrial bank. And I think what is interesting around like targeting inflation is to the extent that your industrial policy has an effect on inflation. And then how is it that you coordinate across your central bank and your industrial development bank so that it's overall cohesive?
Yeah, well, I guess I have an intuition for this, which is that the industrial bank does what they want to do for their own targeted purposes, and then the central bank kind of has to respond. I imagine the central bank in a more passive role, like the central bank is responding to whatever else is happening in the economy and whatever other macroeconomic policy effects are happening and rebalancing their monetary policy to counterbalance any potential inflationary or deflationary effects or something like that.
Yeah, I mean, many developing countries have like, infrastructure banks and then this kind of thing, right? And you could imagine having like, a green infrastructure bank that is, a completely kind of separate institution from the central bank. And there may be kind of pros and cons to doing that. I mean, and of course, as we were kind of talking about the different roles of kind of public financing, I mean, there are also questions as to like whether any of this needs to really be done in kind of like a bank and lending kind of perspective. As someone who kind of started initially in economics in a more kind of like development focus, there's often this huge emphasis on trying to get finance and loans for things as policy solutions. And I'm not sure that those experiences always go super well. I mean, debt has a lot of problems with it. I mean, you got to repay it. It creates a certain amount. I mean, some people like that it creates a certain amount of discipline and kind of stress in the system, but that also means that it can be like fragile and, depends a lot on what your objectives are. If you're, if you, like we don't generally, the way that we like, in high priority things, we don't generally, do them kind of through loans and this kind of thing. I mean, in some sense, we kind of create fiscal spending power and use it. I mean, we pay the army in money, and things like this. And so I think they're kind of, yeah, they're interesting kind of questions about whether it's better to like get a infrastructure bank that provides a 10-year loan to a green firm, as opposed to spending that same amount of money to just build the green thing that you want to build or whatever. And so I think there are, yeah, this kind of brings back this question about, the appropriate role of public finance, and maybe that depends a lot on, or different kinds of public finance, and maybe that depends a lot on kind of the project and its objectives.
Yeah, and I think the appropriate role of the central bank, we can maybe split that even off from the appropriate role of public finance. Like if we, even once we've decided we want a certain amount of public finance, to what extent do we want the central bank to be a part of that? And that relates to the question of central bank independence, political independence, right? And he talks about in the book, well, now that central banks are getting more involved and doing more macroprudential stuff and more targeted stuff that looks more like, the period of France that he's talking about. Does that mean that the central banks need to be more political? We could ask another question. We could ask a different question, which is, if we have a set of things that are inherently not political and are just mechanical and we know how to do them, do we want to split those things off into their own institution? And do we want to call that institution a central bank and leave all of the other stuff out of the hands of that institution? And my sense is, why not? I mean, it feels like you're taking something that you know how to do it and you're separating it out and you're saying, okay, we got this part, and now we're going to figure out the other parts using maybe development banks or something like that.
But do we know that there are things that are non-political and mechanical? Because I think everything will
There
have
you
a
go.
distributional effect. And I feel like that's, the evolution, and like inequality is a hot topic for central bank agenda.
So yeah, that's another important point. Maybe we don't have that. Maybe there was maybe a consensus that some of this didn't have to be political, but maybe that wasn't right. Maybe or there's some consensus that it was kind of automatic and everybody knew how it worked and it wasn't controversial, but maybe now it is, or something like that. So that's an important point too.
Yeah. I think this relates to that theme of kind of what is neutral and technocratic and what's not. We've been going for a while. I always kind of want to make sure that I leave open the last couple of minutes so that if people have any lingering thoughts or questions we didn't get to. But yeah, after that I think we should wrap up so that we don't get too long. So yeah, any kind of concluding questions, thoughts, things to ruminate on? No? All right, cool. So this is a super interesting book. I'm glad we did it. Next time, we're going to read the Minutes of Fiscal QE by George Selgin. It's pretty short, so we're just going to do one session on it. And then after that, we're going to read, or for some of us, reread the new Lombard Street. My guess is probably over like 2 sessions or so, but that's the kind of upcoming agenda.
Yeah, what I remember is that that book is dense, short, but dense.
Yeah. Maybe we can break it up into more. I mean, it's worth kind of at least 2 sessions, but that's the kind of the upcoming reading for anyone interested. So yeah, see you then.